Right now, millions of everyday investors are desperate to get in on the ground floor of the next artificial intelligence or commercial space boom. But if you want to buy a stake in a private behemoth like SpaceX, your money is essentially useless. The private tech market operates behind closed doors, reserving these highly coveted shares exclusively for institutional giants and ultra-wealthy insiders. Recently, a new wave of financial vehicles promised to smash that barrier. Enter the Fundrise Innovation Fund, trading under the ticker VCX. It pitched itself as the ultimate democratizer, a way for anyone with a standard brokerage account to own a piece of the world's most exclusive startups. Financial media quickly praised this newfound access. But look closely at the math behind VCX, and you'll find a pricing structure so warped it turns a genuine investment opportunity into a massive financial hazard. This chart shows the fund's net asset value, or NAV. It represents the actual worth of the tech shares inside VCX, about $19 per share. Yet, on the open market, you aren't paying $19. Driven by retail FOMO, the stock price skyrocketed to over $380. That is a 1,900% premium. In practical terms, retail investors are willfully handing over nearly $20 for every $1 of actual tech assets they receive. Why are buyers blindly accepting this massive markup? And worse, when you pay that premium, what legal entity are you actually taking ownership of? The core of this pricing error comes down to the fund's mechanics. VCX operates as what Wall Street calls a closed-end fund. Unlike standard ETFs, closed-end funds issue a fixed number of shares. Once the box is sealed, it can't expand. When retail capital squeezes into that fixed container, supply can't give way. The price detaches completely from the actual asset value inside. Because this structure lacks any internal arbitrage mechanism to correct the price mismatch, the inflation just builds. It will keep compounding, growing heavier and heavier, until the current owners finally decide they want to sell. Buyers paying $380 aren't investing in artificial intelligence or rocket tech. They are paying a brutal scarcity tax generated by a rigid financial container. The premium is dangerous, but the structure hides a deeper problem. Buying a share of VCX does not mean you are buying a direct share of SpaceX or OpenAI. Instead, the fund relies on a middleman, the Special Purpose Vehicle, or SPV, a separate nested legal entity. This introduces profound ambiguity. Investors frequently fork over cash to SPVs well before legal ownership of the target stock is verified or secured. The disconnect is so severe that executives at target companies, including the defense tech firm Anduril, have publicly stated they had never even heard of the funds claiming to offer allocations of their private shares. Even when the shares are completely legitimate, these opaque SPV structures regularly tack on exorbitant internal management fees, eating into returns on top of the already inflated market premiums. Retail buyers are absorbing a 1,900% markup for a nested legal contract that, in some cases, may not even hold the underlying asset it advertises. Right now, the fund's tradable float, the actual number of shares available to buy and sell on the open market, is artificially low. That sheer scarcity is the only thing supporting the inflated price. But a ticking clock threatens the stability. A 6-month lockup expires in September 2026, freeing restricted shares held by 100,000 retail investors. When that lockup expires, a sudden wave of supply will flood to market. Everyone will look at the exact same exit door simultaneously. Activist short sellers have already targeted the fund. Andrew Left of Citron Research publicly declared a short position, pointing out that simple math makes the current 1,900% premium impossible to sustain. We have seen exactly how this plays out. Similar vehicles, like the DXYZ fund, experience their own massive retail premiums, only to see those valuations totally collapse once liquidity finally hit the market. As Wall Street continues packaging illiquid risks into shiny retail wrappers, we have to ask, are everyday investors finally getting a seat at the venture capital table, or are they just being used as exit liquidity for a structurally flawed bubble?